Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This video is going to focus on the SP 500. I'm going to cover the ASX 200, gold and uranium in a separate video. I'm also going to have a look at one of the weak points in the market, something you need to be aware of, so make sure you stick around for that. As always, this is general commentary, it doesn't take your personal situation into account. With all of that said, let's get into our first chart. So we've got the S&P 500 on the screen, and there really has been quite a bit going on over the last week. And I think there's probably really also a few surprises in that I think for many people, they'll be surprised that the market is actually trading up from where it was a week ago. And it's so interesting when you think about the bank collapses that we've seen. We've had a rate hike and the market's up. So I think the point to take from this is what often seems obvious to people is often not what happens. So this is why I always say we want to follow the price action, not the headlines. It's the price action which is the key to making money and doing well in these markets over time. Now, the dominant feature on this chart is this range. Now, if you watched last week, you'll know that I drew this range in then, and the what I've done with this range is I've used parallel lines. You can see these two blue parallel lines, and different ways to draw ranges. You can draw rectangular ranges, contracting ranges, but this one, which I think works nicely, which fits the parameters of this range quite well, is this downward sloping parallel trend line range. And the big question now is, can this range break to the top side? So I'm going to talk a little bit more about that in a minute. But first of all, let's just go over to the 4-hourly chart, and because this is also really interesting. It's looking at the 4-hourly chart. It's really is fascinating, I think, to just examine the price action over these last couple of weeks, or last few weeks. And what we had, I was talking about this a couple of weeks back. We had this series of spikes to the downside, and it seemed to me like it was an attempt from the bears to really break the market down, to hit stop losses, to get follow through selling, and get that big decline, which a lot of people have been speculating about for some time now. What was interesting is each attempt to break the market down was followed by a quick rally back up. And that has continued. That continued over the last week. You can see around on the 23rd of March we had the so of course that was all during the bank collapses. That period around the 13th of March, around the middle of March, and then towards the end of March we had the rate hike and the accompanying Fed commentary around that. More negativity came in, another attempt to sell the market off, but of course we've got the rally. Now, what's if you've got a good chart eye, you might have already seen this pattern, but we've actually got a head and shoulders, an inverse head and shoulders pattern, where you've got the shoulder in late February, the head in mid-March, and then you got the right shoulder in late March. And I just want to bring this up because it really is a textbook head and shoulders in terms of the market sentiment. And this is interesting because the sentiment's so recent, so you'll be able to relate with it. And so the sentiment during this right shoulder period, this is when the Fed hiked rates, there was commentary from Powell and Yellen. Markets started getting negative on the back of the bank collapses, and there was fear that the market was going to roll over again. That's a typical personality of the right shoulder. And when you don't get the follow through selling, you get the short covering, and that's maybe this is behind a lot of this rally we've seen over during the last week. We've seen short covering going on where the bears just go, look, it's not working, they've got to cover. So very interesting to see how this has been playing out. Now let's go back to the daily chart, and it looks to me that I think with where we're currently positioned, with the strength we've seen over the last week, it looks like there's further upside potential towards the top of the range. I think it's a case of holding on to long positions that are working, and then exiting stocks which are languishing or breaking down. The question of whether we want to add to long positions at current levels, well, look, I think that's another matter altogether. The problem I have with adding to positions at this current point is that it's just not an asymmetric entry point. This is only 2% from the top of this trading range. And so that when you buy towards the top of a range, you open the possibility that the market doesn't break higher and indeed falls back. Now, there's a couple of ways this could go, and there's probably even more ways as well. But like two possibilities are that the market does rally up towards the top of the range over the next few sessions. Maybe it then pauses near the top and then punches through. So that would be that's probably the most positive scenario that we currently have on the table. But the alternative for that, and this is a risk of adding to positions at current levels, is that we do get a rally towards the top of the range, but then we get a reversal and we start to come back down and maybe back towards the middle of the range, retesting support. So buying near the top of a range, it brings out risk that you get the pullback, you don't get the breakthrough. So I'd rather wait for the breakthrough or the breakout at this point in time rather than preempting it. Because preempting breakouts is often you're left with a position you wish you didn't have. And there's also some structural resistance up around where we are now. So let's just draw that in. Just matches up with some of these points. It's around 4,200. And you can see we've had probably just lower that a touch. Yeah, we've had plenty of activity around here over the last several months. So you'd expect with this range resistance, 4,200 structural resistance, there's plenty of reasons, I think, to just want to wait and see, can the market punch through before adding to positions. And but with this range we have in place now, it's you can really visually see why this has been such a difficult 9-month period since May last year. So even a bit longer. It's been difficult because it's just been so much back and forth. There's been no sustained momentum in either direction. A lot of negative sentiment, but there hasn't been a lot of net movement. So we've been in a situation where the bulls aren't winning, the bears aren't winning. It's all the people who've been talking about a crash. That hasn't played out. People trying to buy the dip, that hasn't worked. Momentum, which is what I do, that hasn't worked. Most people have been losing. And it's interesting. I was just looking at some of those inverse ETFs, the bearing ETFs recently, and take SQQQ, for instance, which is the leveraged bear market ETF for the NASDAQ, and just look at what a disaster this has been. So this rallies when the market's falling. So just taking the last couple of months, just this period here, it's just expanding these out. So people are just playing the crash scenario this year are currently losing money. Look where the SQQQ is trading now, and it hasn't been working. People trying to play the crash through the inverse ETFs, it's been a disaster. That's why ranges are just such a difficult period for all concerned. I think the play here is still being cautiously long, and I think that's been the play since we had this key reversal back in October, which if you've been watching for a while, you'd remember I spoke about. It's been the play, and it continues to be the play. We've got key support at 3,900, which has been holding. Below that, it's 3,800 being a key level, being the December low. Whilst they're in place, I think the play is to cautiously take the upside. And now, if you're getting some value from this, please hit that like button. Leave a short comment, just, hey, thanks for the video. It just tells YouTube you're watching and you're engaging, and then YouTube will do its thing and show other people, which really helps me a lot. And hit that subscribe button if you haven't already done so. Maybe come visit me over at motiontrader.com.au and register your email, and I can send you an email notification every time I release one of these videos. Now, let's jump over to something else. I want to show you one of the cautionary flags in this market. and it's the S&P 500 equal weight ETF. So of course the S&P 500 is market cap based, equal weight is a bigger stock, and the smaller stock has the same influence on the price action. And why this is a cautionary flag for me is that it does suggest an internal weakening within the S&P 500. And we've also got lots of technical damage just over the last few weeks with the bank collapse, the sell-off in regional banks generally. And also we've got this big trading range which the market is in, and we're really now right back in the middle of that trading range. And we're also below the moving averages. So that does damage the technical picture quite a bit, really, I think. And there's scope. I think we have scope to get some sort of a rebound over the next week or two. We're already getting a rebound. So we were stretched below these moving averages. We're getting that rebound. I think what's important is just to watch how this rebound develops from where we currently are. Will it end up looking like a bit of a V shape where we continue to get a strong move up, then we get some sort of a pause and then another rally, and then that starts potentially looking encouraging. You start getting the platform, you start getting an overall base, and then possible break higher. But on the other hand, if this rally does start to stall around here and we end up with choppy sideways price action, it then opens a possibility for another push lower. So this is the cautionary flag to the market. We need to see how this plays out. And it's hard to see a whole lot of upside in the near term in the S&P 500 while we do have the equal weighted index lagging. We really want to see the market breadth coming through and the market moving as a whole, not just a few large caps dragging it higher. And just briefly looking at the Russell 2000, the small caps, it's the same situation. Big range. We're towards the bottom end of the range. It's hard to get super confident about a market when you don't have that broad participation. And then also breaking it down further, looking at an iShares micro cap ETF. This made a new low just this week. So again, it's I like to see the market moving in sync. I don't like seeing NASDAQ 100's looking good, but then you got other spots which just aren't lifting their weight. So that's a caution for the market generally, I think. So I think that look, ranges are just as we've got at the moment. Ranges are just such a battlefield. And not just financially. Financially, they're difficult because they chop and you get whipsaw and you get in and out of positions, but also emotionally. They take an emotional toll. But I think the big thing to remember is that these trading ranges, they do end and trends do return. We just need to ride them out. We need to be cautious. We need to protect our capital whilst they're in place. And I think your advantage as a private investor is that you can choose when to play. The guys at hedge funds and investment banks, I know I've been there. It's you can't kind of sit it out for 6 months and be super selective in what you do. You've got to make things happen. Private investor, you've got the luxury of being able to wait for the right opportunities to present. Only swing when the setup looks good. You don't need to play at everything. So my preference, as I've been saying, remain conservatively long, but it's just not a time for big bets. We just don't know how long these ranges are going to last. But remember, they will end, and I think typically when a range ends, you get a big multi-month move, particularly out of these large ranges we're currently in. So the setup's being created. We just got to wait for the time to play it. So hopefully that's been interesting. Hopefully it's been good to it's been good talking to you. And look forward to coming back, having a chat to you next week. Till then, bye for now.